Welcome back. I've recorded 4 videos so far, and I thought it might make sense to go back to the beginning. Those were fairly advanced topics. So go back and talk a little bit about the background before we got to those advanced topics. One of the questions I get asked a lot is, what is value investing? And you probably ask 10 people and get at least 10 opinions on what that means. There's a definition on Wall Street that tends to lean towards low price to book, perhaps low price to earnings. However, with the changing nature of balance sheets, the low price to book value may not matter as much as it did at one point. Low price to earnings, yeah, potentially, although I don't think it captures all of the key issues in value investing. So this mini lecture is really going to try to answer at least that question. Ends up that there's maybe 3 questions involved in answering that first question. Sure, what is value investing? I think it's important to have a working definition, a definition you can use day to day. And then often on Wall Street, it's you sort of see a juxtaposition of value investing versus growth investing. So I want to talk a little bit about how value investing differs from growth investing, or maybe it doesn't. And then if they are really opposite styles or opposite approaches, then you would see some sort of transition. You would go from value to growth or growth to value. And I'll show you, I think in a minute, that that transition is not so obvious, which then calls into question whether or not value investing and growth investing are really as different as Wall Street wants you to believe. So let's see if we can answer these 3 questions. Let's start with, what is value investing? Often I hear, when I ask people what is value investing, I get a description or an answer similar to this statement: price, market price, the price you can buy the security, less than intrinsic value. Now, I will do a future lecture on this whole notion of intrinsic value because that's more complicated than it seems. The first instance of the phrase invested capital we can come up with is 1934, Ben Graham in his book, Security Analysis. Interestingly, intrinsic value also shows up in a letter that John Maynard Keynes wrote to the trustees of King's College, where he said he thought the intrinsic value of the endowment's portfolio was much higher than the current price. Don't know if those 2 gentlemen ever communicated, but intrigued to see the same phrase. All right, so I'm going to abbreviate that to be price is less than value. I'm going to move away from the idea of intrinsic value. I don't think it's well defined. Even Graham struggles with it in his 1934 book. And really just say price is less than value. And I will abbreviate that as P less than V. So we're going to use that definition as we explore sort of the nuances of the question. All right, put up a little chart, my first chart, which is I've depicted a situation where price, P, is less than value, V. And so ask a simple question: are you interested? And when I show this chart to students and other people, most people say, yes, I'm interested. Price is less than value. But there's an important follow-on question because there's an implied assumption, and that is that V will have a stable future value. And that's key. And I'm not trying to split hairs here. It's unbelievably, although nuanced, it's unbelievably important, because without a stable future value, as I'll show you in a minute, the original equation starts to break down. So now I ask the question slightly differently. P is less than value, today's value, and best we can come up with, our confidence level's high, future value will be fairly stable. I've drawn this as a straight line, doesn't have to be perfectly straight, but the future value will be stable over time. Now, are you interested? A lot of people are interested. And the assumption is that P will move to value. So in this case, I've added price because I want to do a couple of quick calculations in a moment. So here's the assumption. Here's the setup. P is less than V, price is less than value, 14 is less than 20. And the assumption, again, now our second assumption, is that P will move towards V. And that's really important. So we started this little discussion with value investing is P less than V, but there are 2 more things that take into account. One, a stable future value, and that P moves to V. Now, might be saying, well, of course. I'm not so sure, of course gets us there. I think you really want to think through that. How stable is the future value? And how quickly, as you'll see in a minute, P is going to move to V. All right, now, once we have this chart, we can do some quick calculations. I have set this up as a 1-year target. P goes to V in 1 year. That's time. On the left, I've labeled this as your total return. So the total return from 14 to 20 is $6, obviously. And then your rate of return is that 20 divided by 14. Now it's technically 1.42%, but I've eliminated that last step. So the rate of return would be just shy of 43%. All right, is that interesting? I think for most investors that is interesting. But there were two key assumptions. One is that the future value would remain around $20. And the second is that price would go to that $20. Now, if we change the time that it takes for price to go to value, we change the annual return pretty significantly. In the first year, price goes to value 14 to 20, 43%. Now, if it takes 2 years, it's still going to be 43% total, because that is your total absolute return, but it's because it takes 2 years, it's 19.5% per year. And then if it takes 3 years to get there, it's 13%. All right, so now we've discovered a couple of really important things. Yes, value investing is P less than V, price less than value, but it's future value, because we need to understand what that is. And if we care about the rate of return, not just the absolute return, but the rate of return, we also care how long it's going to take for P to go to V. All right, I think those are important subtleties that we've added to the discussion. All right, here's a case where we have P less than V, current value is less than, price is less than current value. However, it's an erosion in value over time. Are you still interested? At this point, most people say no, they're not interested. Although again, that's not so obvious. The way I've drawn it is if, in fact, price were to go to value in 1 year, you'd still make 21%. That's pretty good. If it took 2 years, that's a problem. You're going to have not much of a return. And then if it took longer, you'll have a negative return. So you could be interested, but time is not your friend in this case, whereas in the case before, time was your friend, although it worked against you if it took longer for price to go to value. All right, so future value is really important. I hope that's starting to be obvious. So P less than V, yes, but P less than future V. I'm going to come back to that a couple of times. And then second, of course, is that P will accrete to value, not just sit there. All right, now, with an increasing future value, this should be very interesting because now time is your friend. Price is less than your estimate of current value, but price is also lower than future value because your estimate of future value is increasing. Now, I just put down that the future value is increasing at 25% a year, just so we can do some calculations. All right, once again, depending on how long it takes, will in fact influence your return. Now, your absolute return goes up over time because value is increasing versus price. And your annual rates of return are still pretty amazing, although they do come down because it takes a little bit longer. 1 year, it's 78.5%. If it took 2 years, given the 25% increase in value, you're about just under 50% a year, still pretty impressive. And 3 years, given that you have this high growth in the underlying value, you still have an amazing return. So growth in value is always interesting, and if you add a discount to that, it boosts the annual return. So that's pretty cool. All right, now let's get a bit more challenging. We had in the case right before this, the price is less than current value. What if price is equal to value? Now, in a sense, we violated our initial definition, price is less than value, in that simple case. Now, I started to emphasize its price is less than future value, which I think is really important, and this will highlight that even more. Now, price is not less than current value. It's, in fact, equal to current value. Are you still interested? I hope the answer is yes. Let's just say that price does nothing. It just moves sideways. You don't make money. You don't lose money, mark to market. But the gap between price and value starts to increase, obviously, and your potential return goes up over time. So I hope I'm demonstrating in fairly simple graphic, that even if price is equal to today's estimate of value, as long as that value is increasing in the future, you can, in fact, make money. And depending on the slope of that increase in value, you could make a lot of money. So this idea that price is less than value is too naive, too simple of a phrase. It is price less than future value. I often hear that the benefit of value investing is you don't have to predict the future. I think, well, that's a little tricky. You have to at least be comfortable that the current value will be stable over time. And the problem with growth investing is you have to forecast the future. Well, depending on the price I pay, I may not have to do much of a forecast in growth investing. If I'm getting all of that growth for free, which I am in this case, I don't have to be precise in my estimate of growth. They just have to be accurate that value is increasing. So I'm hoping that simple definition that you often hear about value investing, price less than value, is way more complicated and more subtle than the phrase would suggest. We have to care about future value, whether it's stable future value or growing future value. And then, of course, the price we pay influences dramatically the return we get. All right, so if price tracks value, obviously we're going to make money. And if the growth rate in that underlying value is 25%, price tracks value, our annual return will be 25%. All right, that should make sense. All right, let's get more complicated now. What if current price, is greater than current value? Are you still interested? A lot of people say, no, I'm not going to pay a premium to value today. It's too risky. Now, I will come back in a couple of lectures to talk a little bit about risk, because most investors I meet do not have a well-defined sense of risk. I touched on that a little bit in some of my prior videos. All right, so people are saying, no, I don't necessarily want to. I'm not interested in this stock because price is above value. Well, here's something that's interesting. It's true that if you pay a premium to today's value, you are paying for growth. And most of the companies in today's market, you're paying for growth, something I refer to as value of growth. You've seen that in some of my prior lectures. However, as time goes on, if that growth is high enough, you absorb that initial premium and then you have this potential return. So there's no question you're paying for some growth, but in at least the way I've illustrated, you're not paying for all of the growth. So this is certainly a riskier situation, and you need to be more accurate in your estimate of growth. But I wouldn't throw this away so quickly to say this is not value investing. There's something different about it. It sure feels the same to me, although I am prepaying some of that growth. Now, if my chart's correct, I'm not paying for all of the growth, and therefore I'm getting that secondary growth, that later growth, for free. All right, interesting sort of setup. Now, if I have a 25% annual growth in my value, and by the way, I set this up to pay a 25% premium to the current value, I'm essentially paying for 1 year of growth. Now, no question that future growth is less certain than current growth. So therefore, my range of estimates on future growth probably is going to be wider. And I will talk about that in future lectures. I just wanted to get some of the basic concepts down today. All right, so if the price goes to value in 1 year, I haven't made any money, but now all of a sudden I'm back to that earlier case where I'm buying a stock that has a 25% growth in value. And I am getting that now. In 1 year, I'm getting that essentially for free. Or another way to think about it is that price takes 2 years to go to value, I get a 12% return. And if it takes 3 years to go to value, I get a 16% return. And over time, if that growth rate continues, the growth in value continues, my annual return will increase over time, asymptotically getting to that 25%. So just because a stock is higher today than the current estimate of value, I don't think that disqualifies it as a value investment. Sure, price is not less than today's value, but I'm hoping at this point in this discussion, that is less of a constraint than you might have thought before watching this video. All right, here's something that's interesting. Let's say I pay a premium to today's value, that 25% premium. The value increases 25%, but the premium holds over time. Now, all of a sudden, my annual rate of return is equal to my growth rate. And I think most individuals that invest in growth are thinking along this way, is that the premium will hold. Now, the premium holding is very similar to saying that the PE will hold. And as any of you that watch my videos, you'll know in the last video, I talked about PE's holding. This is the visual connection back to that lecture. All right, how about if the premium actually increases, the PE expands, which is quite possible. Maybe investor expectations about the future growth or profitability increases. Now, all of a sudden, your rate of return is greater than your annual growth rate. And we saw that. If you go back to my lecture on Apple, that's what Buffett saw in Apple after his initial purchase in 16, is he saw a dramatic increase in the PE, dramatic increase in the market implied value of growth, that green area that I talked about. All right, so here are the three possibilities that you get when you are investing. Price is greater than current value, estimate of current value. It can converge. That's the one on the left. And then your annual return is less than your growth rate. Still may be very impressive. If the growth rate's 25%, I could still get a pretty impressive annual return. If my premium holds, my PE holds, my market implied value of growth holds, then my annual return equals my growth rate. And if my premium expands, my PE expands, or my market implied value of growth expand, then my annual return is actually greater than the growth rate. So I think I'm hoping we've tied kind of value investing back to growth investing, if you want to call it that. All right, and then a higher growth is always a higher potential return at all prices. That should be obvious, but just show you the graphic. All right, so the first one we answered, we at least I think attempted to answer what is value investing. To me, value investing is price less than my estimate of future value, with the assumption that price and value will converge. Price will converge to value. I don't want value to converge to price. So to me, the definition of value investing is price is less than future value, with the assumption that price will converge to that future value. All right, now we're prepared to answer the second question. How does value investor differ from growth investing? I'm going to go back to Buffett, and many of you have seen this. This is the quote from his 1992 annual report, where he said, very simply, he was asked the question, how do they decide what is an attractive investment? And he goes on, I'll read this. In answering this question, most analysts feel they must choose between two approaches customarily thought of to be in opposition, value and growth. Indeed, many investment professionals see any mixing of the two terms as a form of intellectual cross-dressing. He goes on to say, we view that as fuzzy thinking, in which it must be confessed I, Buffett, myself engaged in some years ago. In our opinion, the two approaches are joined at the hip. Growth is always a component in the calculation of value. I think I've demonstrated that in my charts, at least I hope. Constituting a variable whose importance can range from negligible, we saw that in the case of this stable future value, to enormous, which we showed in the case where you pay a premium, but the underlying value is growing at 25%, and whose impact can be negative as well as positive, as I showed in that case where the future value was declining. All right, Buffett goes on, I think this is important. We think the very term value investing is redundant. What is investing, if not the act of seeking value, at least sufficient to justify the amount paid? That's that P versus V relationship. Or I hope at this point you're thinking P versus future V. And then, consciously paying more for a stock than its calculated value in the hope that it can be soon be sold for a still higher price should be labeled speculation, which is neither illegal, immoral, or in our view, financially fattening. Great little term. All right, so now Wall Street wants you to think value and growth are different. I tend to think of them as very connected. In fact, I would argue it's all value investing, or at least fundamental investing. And that growth and value, traditional value investing, is a subset of fundamental investing. And growth investing is a subset of fundamental investing. All right, so if they were different, we would be able to identify what I call the phase transition, the style transition from one into the other. Now, here's a phase transition all of you are very comfortable. Water. When water gets really cold, around 32 degrees Fahrenheit, the motion of the molecules slows down and it forms a crystal we refer to as ice. That's a phase transition. And if that same water gets too hot, molecules start moving very fast. You see a phase transition into steam. So I want you to keep this in mind because there is no phase transition from value to growth. And because of that, it's hard for me to say they're opposite investment styles. If there were, there would be this cool phase transition. All right, so let's answer our question. What is value investing? Price less than value. How does it differ from growth investing? It does not differ. They're the same thing. They're both fundamental investing. And you just have to decide how important growth is in your calculation of future value. If it's a key determinant, then you're going to have to spend time figuring out that your confidence around that growth estimate. That's my tools. The value of growth tools is trying to get at, and we'll come back to that in future lectures. And then finally, when does one investment style transition into the other? It doesn't. There's no transition from value to growth. It's either value investing, fundamental investing, or something else. All right. I just wanted to add, its price is less than future value. All right. And then I'll just come back to Buffett to make the point. We think that the very term value investing is redundant. What is fundamental investing if not the act of seeking value at least sufficient to justify the amount paid? All right, so just to push this up, he says that if it's not fundamental investing, it's speculative. So I want to touch on this for a moment. Fundamental investing, fundamental analysis is the asset has a fundamental intrinsic value, usually based on future cash flows. Not always, there are other future values, but that's the case. And fundamental value, V, determines your investment strategy. If price is less than that future value, you would buy. And if price is greater than that future value, you probably would want to sell. All right, so that's fundamental investing. Call it value investing. I think it's all the same. Speculative investing, not such a thing, but speculative assets are an asset without a fundamental intrinsic value. There is no fundamental value, and generally it's because there is no cash flows associated. So gold has no fundamental value. Crypto has no fundamental value. I know people at this point are disagreeing with me, but I would ask you, I challenge you, show me the fundamental value. Now, speculative investing, hard to say the two together, but speculating on price changes. So speculative behavior, speculation in the market, is just betting on price changes, which is a function of supply and demand. However, there is no systematic way to determine investment strategy based on changes of prices. Changes in prices do not help you in speculative assets because all you can do is look at supply and demand. Now, if supply is constrained, which is true about gold and true about some of the crypto, then all you have to do is worry about demand. But it's changes in demand that determine price, not changes in fundamental value. So I think that's really important to compare the two. All right, final set of comments is I just want to add this point. This is a quote. I came up with this quote a couple of years ago. In my mind, investing is an act of arrogance. In fact, I think it's a supreme act of arrogance because every time someone buys a security thinking it will outperform, someone else is selling that security because they believe it will underperform. Now, I know there are exceptions, information selling and noise selling, but in reality, there are two sides to every trade. One person is excited to be buying, and one person presumably is excited to be selling. I think that's important. One of these investors will be wrong over time. And I ask you very simply, why do you believe you're on the right side of the trade? Over the next series of lectures, I want to give you some tools that I believe will help you be on the right side of that trade. All right. Thank you very much for listening.